Today we're going to talk about an investment that most of the time I actually avoid because most of the time it's not a good investment, at least in my opinion. But in certain times, like the times we're experiencing right now in the market, it does become a good investment. And this is an investment I don't see many other YouTubers talking about, so I figured I would go over it because it is important. This is an investment that should fit into a broader view of the market, which by the way, we'll do a market overview too to see how it fits in. But before we do that, make sure you check out the explosive stocks checklist because this is more along the lines of what we normally talk about on this channel. And a lot of these stocks will actually benefit from this volatility. So you can jump in, ride it higher, and jump out. So there's a link down below in the description and comments. Click that, go to this page and download it and get started today finding these profitable stocks. So the investment that we're going to talk about today is the one that makes people the most crazy. I'm talking about gold, the least bad alternative, as Alex calls it, because of course we got this article from Macro Ops, our latest research. And I'm not a big gold guy. I don't talk about it much on this channel, as I said, but gold is looking like a pretty good investment right now, and I will explain why. So back in March of 2019, over a year ago, we actually released some research saying that gold was about to pop. So here's that research, March 26, 2019. You can see with this red line down here that volatility, which is measured by the distance between monthly Bollinger Bands, that volatility hit an all-time low. And that last time that it hit such low volatility was back in 2002 before it went on a massive run. So we were looking for another run to happen. And sure enough, like a month after we published this, gold took off. Now looking at the volatility of an asset, like I'm explaining here, that's one good way to see if a big move is coming. Because compressed volatility isn't actually a bullish or bearish signal. All it does is signal that an inflection point is coming. If you look at the structure of markets, low volatility always leads to high volatility. It's like a pendulum that swings back and forth. So if you see low volatility in an asset and you see that compression happening, which you can also see in the price chart with price patterns, that's the point of them. That means that soon enough we'll be in a more volatile regime. And the nice thing, as Alex says here, you don't need to discern any big macro narrative to try and figure out what's going to happen. All you got to do is wait for the market to break out and then you just play what's happening. So with different assets, if you have the ability to go long or short, does it matter which way the asset is going? No, because you're just trading it. Here's another good part of this research from Barton Biggs' Hedgehogging. Great book if you want to check it out. But they talk about how to value gold. So in a low return cycle for stocks and bonds, monetary and investment demand for gold turns positive. So people want more gold. And like there's always going to be, there's a dramatic shortage of gold. So then obviously what happens if you have a low supply and demand increases, then you're going to get those higher prices. So it's not inflation or deflation that's the principal driver of gold, like most people think. You got a lot of crazies that are just obsessed with the debt and just want to buy gold all the time. The gold bugs. So they're always worried about that inflation. But really what drives it is the return from other long-term financial assets, particularly equities. So if stocks are doing poor, you're going to see more people buy into gold. That's the correct way to evaluate it. And the way I'm talking about analyzing gold here is also how our favorite guy in the world, Big Daddy Dalio, that's how he does it too. And I'll mention him a little later in the video. But going back to our most recent research, because obviously it's been over a year since that last piece, Alex quickly goes over how you view gold through a fundamental perspective. So first of all, the total amount of investable gold is tiny compared to how much actual capital is out there. So you got 1 to 2 trillion in gold versus 250 to 300 trillion worth of money. Again, all of this goes back to supply and demand. That's all markets are. So in this case, demand is what will drive gold prices higher because supply is almost fixed. Obviously, they're still mining gold, but it's very little. And since gold is not a productive asset, what drives its return is actually how other financial assets look. So stocks and bonds. As we just mentioned, if stocks and bonds are looking bad in terms of their returns, then people are going to flood into gold. As it says right here, when expected returns for stocks and bonds are high, gold does poorly. When they're low, gold outperforms everything else. So everyone loves to talk about inflation and deflation and crisis insurance, but that's not really what drives it, as we said. Really what gold is a steady store of value in times when the expected returns for everything else are low. And because the supply is so tiny, it doesn't take much of a shift in demand to really send prices flying. Okay, so if that's the case, then let's look at what people are expecting for returns in stocks and bonds. And right here, according to GMO's 7-year forecast, US large caps are expected to lose almost 5%. And then US bonds are expected to lose almost 2%, both negative. And if you look at the expected annual nominal returns for the S&P over the next decade, it's only 1.1% according to this chart right here. And if the returns are so bad in stocks and bonds, then as we've learned, what are people going to want? They're going to want gold. You can see from this chart that gold has been in a technical uptrend for over a year now. And now it's working through a big supply overhang in this area above 1600, meaning all the people who bought back here and tried to hold through all of this, they're probably selling out around here. year, so you got to work through that. The demand has to overcome the supply again at this area. And really that's all price charts are, right? Supply and demand on a piece of paper or computers now. And this whole rise has been helped by real yields going down. So the 10-year yield is the most negative since 2012. So fewer returns elsewhere, people want gold. I guess I'll just keep repeating that statement over and over. You can see here that the US 10-year yield is basically following other countries that are further along in their long-term debt cycles, because this is what happens. Like Japan provides the roadmap. They're this white line right here. Germany followed suit. And then of course the US in yellow is heading lower too. So Alex expects to see zero rates across most of the curve and some form of yield curve control before this is all over, because we just have so much debt now. So short-term things do look good for gold to explode higher because we have this short-term head and shoulders pattern. But what we need is for gold to close above that 1700 level. You can see here it tried to break through and then it failed. Doesn't mean the whole pattern is null. It might still fight around this area, but we gotta wait and see. That is potentially a good entry point though if it does break above and hold. But this 1700 level right here is acting as resistance. So Alex is expecting gold to break out, and then over the next 6 months it should take out its all-time highs. And that's what he thinks over the long term. But over the short term, you know, anything is possible, because we could go into a full-on liquidation mode again. And he's talking about that time period when everything was getting sold. Every single asset red, which you guys remember I made a video about that. That doesn't happen often. Actually, I don't think it's ever happened. We have bonds, stocks, gold, Bitcoin, everything just negative. So he would step back on the sidelines, as in get out of his position, if price dips below the right shoulder near the 1550 support level. That's all the way down here. And just one more recap, because I forgot to mention, is that over the long run, and this is how Dalio looks at gold too, the price of gold is going to approximate the total amount of money in circulation divided by the size of the gold stock. So it's supply and demand more than anything. And it's not inflation or deflation that's the principal driver, but the return of other long-term financial assets. Those are the two important points you got to remember when you're evaluating gold. Now, as we were showing, gold is in a very good position to break out, because now if we look at the most recent market research, we know, well, at least I know, I'm going to explain to you, that we might be getting ready for this second leg down. The market has had a beautiful run since the bottom, but it's a bear market rally. And we've been talking about this the whole time it's been happening. So if we do get this collapse soon, when markets fall and then break the low, then you can see gold explode out of its pattern. But let's cover that real quick. So the S&P 500 has jumped 25% off of its 323 low. And you know, I talked about this before. Everyone was real worried that they missed the bottom. But according to how bear markets work, we know there's usually a secondary bottom after a big rally. So the question about this rally that we're having right now is it only getting started? Is it midway, or is it over? So we can look at past bear market retraces to kind of give us an idea. So going all the way back to 1920, the index that, you know, eventually became the S&P, it's registered 14 bear markets. And a bear market is a 20% fall from a record high. So within these bear markets, the market has had a rally in excess of 15% on 19 occasions. There is 14 bear markets, but 19 bear market rallies. So on average, it happens more than once per bear market. So it's a standard occurrence in a bear market to see the rally. So right here is a list of every bear market rally, the duration, as in the number of days, and how much the increase was. So sometimes you have super short rallies, as in just 2 days and the market shoots up 18%. That's what happened in 1929. You got another one in 1932, 2 days, 16%. We had one in 2008, which was 8 days and 18%. But you can also get super long ones. So here in 1929, we had a 148-day rally and the market went up 46%. Imagine how crushed people were when it turned around and went lower. And then another super long one was in 1947, 393 days, over a year. And the market went up 23% during that time. So you can see that it really varies. Currently, we're at a 12-day rally that has gone up 25%. So the median bear market rally has lasted 35 days and rose 19%. But again, within that data, there's a lot of dispersion because the rallies went from just 2 days to over a year. And some rallies stalled at 16%, where others were as big as 46%. So it's a wide range. So the current bear market rally that we're in right now, it can either go up or down from here because it's in the normal range of bear market rallies. The 12 days is on the shorter end compared to the past, but the return is already above average. So Alex thinks markets are going to turn around from here. Maybe we get a little short dip followed by one more run to the highs. That way we suck in the last of the bulls, because that's how the market works. It wants to hurt the most amount of people possible. You can see right here that the S&P is hitting its upper Bollinger Band. So we'll know over the next few days whether it's going to keep going higher or collapse lower. And I'm recording this Wednesday midday, and as of right now, it looks like we might head higher before eventually turning around. I would have to wait and see what the close looks like. So Alex is looking at getting long bonds and long gold if things turn around. Because as we've explained before when we went over this research, we think that the market is still vastly underestimating the destruction that's occurring in the real economy. 15% plus unemployment is a lock. And we've explained before that a V-shaped rally doesn't exactly make sense because businesses just can't start up, not when they've been closed. So the economy isn't going to magically recover super quickly. And I think people will only start realizing that when we do get out of lockdown and we see that a lot of the restaurants and places that we like to go are shut down because they didn't survive through this. So again, we are just at the start of the bear market, not the end. The median bear market lasts 81 days, past the initial 20% drop, and then it usually experiences another 18% drop from there, but it doesn't happen all at once. So while we could continue to run higher, and we might, what's eventually going to happen is that we turn around and retest this wedge down here. So that's this green line. So again, that's a lower bottom than what we already hit. So we'll see what happens, but me personally, I'm hoping that we just keep running from here, because the system that I use, the NASDAQ All-Stars, the momentum system, we just rotated into all brand new positions at the start of April. And because the market has been flying higher, we've seen some great returns, but we haven't hit our targets yet. And the reason why I want to hit the target is, first of all, so I could take some money off the table, actually lock in some profits. And then also when I hit that first target, that's when my stops move up to break even. So it'd be awesome if we hit the target, market turns around and our stocks drop, but we get out at break even. So net, we're positive even though the whole market collapsed again. But that's wishful thinking. Market wants to cause the most amount of pain possible, right? So what's probably going to happen is that I don't hit my targets and the market turns around and I end up taking losses on all my positions. That's the risk. Now, based off this research, it becomes very tempting to just go take off my positions right now. I've got a decent gain, let me lock it in. But that's the thing about systems. You don't start mixing in your discretional opinions with what the system is doing, because they don't mix. I've done it multiple times before and it's always been stupid. So in this case, I bet if I took my positions off, the market would just continue running higher and then I'd be screwed because I would just lose that huge opportunity. That's why even when we talk about research like this, you still got to take it and fit it into your own strategy or system and make sure you're not breaking it, because we all should have had plans before this happened. And for me, I just got to detach and just let the system do what it does, because I know how it works over the long-term cycle, what the potential returns and losses are, and I'm good with that. So instead of messing around with your current strategy, you can also just look into studying this explosive stock strategy, because with these massive market moves that we've been seeing higher, a lot of these explosive stocks will explode even more higher, because with the massive move higher in these markets, all these explosive stocks will really benefit from it. So definitely check this out and you can get started today. Obviously started on a different portfolio with different money, or just started learning. Either way, get started today. There's a download link in the description and comments. It's all free. And if you like this video, make sure you subscribe, because we will be doing more market analysis and I still got to get that billions video out. So subscribe and I'll see you in the next video. Stay fallible out there. Bye.